technical analysis remains more of an art than science, but recent studies suggest that technical analysis does have merit to predict the financial market's direction. Technical trading rules are widely used for market direction assessment and investment timing, but this must be combined with responsible use of leverage and specific locations for stops. Trading is most effective at points called points of price instability. This was Curtis Faith's idea. He was one of the turtles, and gave examples where trend lines, moving average and pivot points converge to yield areas where prices are unstable. It is for this reason that most knowledgeable investors will be entering or exiting positions at these points. These points of price instability will have a high density of stops, so it is for this reason that leverage and stop location becomes important when trading around these levels. There are countless rules and systems that traders use to execute orders. The purpose of this is to avoid discretionary trading and hope for a more system-based approach. By using a mostly system-based approach with some discretionary input, the trader hopes to minimize the influence of emotional distractions, plus systems can be backtesting. Emotional distractions fall across several time scales and involve predominantly the intraday drawdown, a series of losses, or the prolonged drawdown period. It is also assumed that a good understanding of micro and macroeconomic fundamentals combined with an astute technical ability and a solid disciplined approach will help the trader be profitable at the end of each week and avoid emotional beat-ups. The most important aspect of trading is discipline. It implies not dwelling on mistakes, still trading good signals after losses, good money management, and generally staying mentally robust. Discipline also involves sticking to a plan, as there are too many applications of technical analysis. They vary from simple ideas on using moving average rules used to make buy or sell decisions over different time frames to more complex systems using multi-indicator setups. I prefer the multi-indicator setup, and I tend to think of key levels more on a diagonal trend line than pivot level, because I've used trend lines more than the CQG ladder and the horizontal pivot points. Historical prices regardless of time frame, yield patterns, and trend lines that exhibit regularities that can give a trader a statistical edge to select market direction. To summarize technical analysis, there are two general approaches. One involves qualitative techniques and the other quantitative techniques. The qualitative techniques rely on perception and the interpretation of various geometric patterns such as double bottoms, head and shoulders, and support and resistance levels, etc. Currently, the computer vision problem remains the biggest hurdle in artificial intelligence, so it's unlikely the black boxes rely predominantly on this approach. They account for half the volume and are worth a mention. The second technique is the quantitative approach, which crunches times, price and volume or combinations of these to create indicators such as moving average and relative strength indicators, etc. Humans use a combination of both methods, and the algos predominantly use one method, a clear system-based approach. It is felt the algorithmic traders add volume and this can reinforce the patterns. However, many traders say the markets are now more difficult to trade since the black box was introduced. It remains a mixed blessing. Both techniques can be characterized by selecting high and low prices in regards to the market's most recent history and in what direction the trend is going. On a more complex level, the market can be considered a complex system that oscillates between order and chaos. The order can be considered channeled trends or ranges. The chaos might be the reversal pattern or all the messy market noise between points of price and stability. The chaos is basically the places that traders tend to get chopped up in. This view resembles the adaptive market hypothesis. On a more simple perspective of market dynamics, according to the weak form of the efficient market hypothesis, historical price information is already reflected in the present price. Therefore, technical analysis is totally useless for predicting future price movements. I feel the efficient market hypothesis is a weak analogy and one just needs to be very picky with trading instability points. In recent years, the efficient market hypothesis has been directly challenged by a fair amount of studies, many of which compare dynamics to chaotic processes that yield the potential for nesting and attractors. An attractor can be considered a pivot point about which a price oscillates around, or it can be resistance or support. While technical rules are commonly used, they may not yield a profitable strategy because of the emotional limitations experienced by the trader. To overcome fear and maintain a logical approach, there is no simple way to efficiently say how to apply the technical rules and how to adapt them to various markets. It takes many years of experience reading charts in real time and trading to do this. One just needs to avoid wiping themselves out until they get a breakthrough. Overall, the trading problem is not about prediction, it is about selecting a point to enter the market that gives the lowest risk and highest probability of reward. It is important to pick an application of technical analysis that allows you to avoid getting beaten up emotionally and to feel comfortable risking capital while experimenting with the market.